Good afternoon and welcome to the SEVERFIELD PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Alan Dunsmore. Good afternoon to you, sir.
Good afternoon and welcome to our half-year results presentation. I'm going to give a brief introduction and overview of the highlights. I'll hand over to Adam Semple to talk to the financial results in a bit more detail. Then I'll come back and talk a bit about strategy, a deeper dive into the different business units in the UK market, a bit about India, and then we'll wrap up and take questions at the end. So, starting with a reminder of the five pillars of our investment case, built around exciting growth prospects. We've aligned the business over the years with strong growth potential in the UK and Europe, and also we have significant opportunity to grow profits and build value with our Indian joint venture. I think we've proved over the years that the business is resilient through the economic cycles. We've got a range of different sectors, and they all have their own cycles, which in effect means they largely cross out and provide a degree of resilience for the business as a whole. We've been developing the kind of the platform for operational excellence over many years, involves both capital investment, operational efficiency, and most recently our Project Horizon digitalisation programme, which we'll say a little bit more about later on. The business has delivered and will continue to deliver strong returns. The cash generation is good, and we've got a kind of rolling return on capital employed of in excess of 15%. I think the value of that can be seen as the business progresses. And finally, but importantly, is the underpin of sustainability, which we've been developing over the last few years, and we believe we have a kind of market-leading position there, and it's become increasingly important in everything we do across the whole business. So moving on to the headlines, for us, the kind of the important part is the further increase in profit before tax, up 17% to £14.2 million for the 6 months on revenue of £215.3 million, which is slightly slower in the comparable period due to slightly softer market conditions, which Adam will expand on a little bit later. The increase in profit really comes from continued good execution of the order book, which is a key part of what we try to do. The balance sheet's in good shape. We've got net funds of £0.4 million at the end of the period, reflecting good cash inflow and working capital improvements in the period. And that positive 0.4 includes the debt from the acquisition of Voortman at the beginning of the period as well. So that's a good performance, we believe. The order book at £482 million is steady over the last few months compared with June and September. If we unpack it a little bit, looking at the movement from the June position, we had a cancellation of an order for Sunset Studios in July. That was kind of well publicised. So that resulted in £50 million coming out of the order book. And you look at that and also ongoing revenue, we've actually taken in about £200 million worth of new orders over the last few months, which we think is a strong performance. The value continues to build in the Indian joint venture. The share of profit was £0.6 million in the period. But an important news and development is that we've now secured a plot of land to facilitate the building of a second factory, and that plot of land is in Gujarat. We'll say a bit more about that later on. The Indian order book at £165 million, steady from September, but represents a step up from where we were in June, and we see the pipeline of future work continuing to grow as well. So all in all, another good set of progress over the last few months, and that gives us confidence to increase the interim dividend up 8% to 1.4 pence per share. I'll now hand over to Adam to go through the numbers in a bit more detail before I return to talk about strategy the markets.
Good afternoon, everybody. As Alan said, we've had another good set of results, and we've reported a step up in profits and also a period of strong cash generation. You can see from the P&L that revenue for the period was £215.3 million, and that was a decrease over the previous period, reflecting the continuation of some challenging market conditions that we'd flagged at the time of the AGM statement. Underlying operating profit was £14.8 million, and that was up 22% over the previous period. And this increase reflects improved profitability from our core construction operations, which now include Vertman, and also improved result from Modular Solutions, which we're pleased to say has reported a profit for the first time. The share profit from JVs and associates of 0.8 million, that includes 0.6 million from JSSL, our Indian joint venture, which represents an unchanged profit position, whereby an improvement in the operating margin is helping us offset slightly lower activity levels in H1. So overall, underlying PBT is 14.2 million, is up 17%, and the interim dividend of 1.4p per share is up 8%. Overall, our expectations for the full year are unchanged, despite the current market backdrop, and given our strong track record, diversified operations and high quality order books, we expect to deliver further progress in the second half of the year. We're now reporting results under our new divisional structure, which we announced around a year ago. And our core construction operations include the combined results of our commercial and industrial division and our nuclear and infrastructure division. Overall revenue of 208 million was a reduction of 9% over the previous period. And breaking that down into the divisions, in C&I, revenue has decreased by 9% to 166.5 million, representing the impact of some softer market conditions in the distribution sector, and also the pause in construction at Sunset Studios. And those two in combination have reduced revenue by £48 million, and that's been offset by the new revenue from Vertman of £28 million. In N&I, revenue has decreased slightly by around 7% to 41.5 million, and that's driven by the market conditions in the infrastructure, but also the normal nuclear timing differences that we see in revenue in that business. From a profit perspective, underlying operating profit has increased by 16% to 14.7 million, and that reflects an increase in underlying profitability of £500,000 and the new profit from Vertman of 1.5 million. And you'll see that the increase in overall profits reflects continued contract execution improvements, which again is helping us offset the drop in revenue sort of H1 and H1. Our strategic targets, which we announced back in our Capital Markets Day back in March, they're unchanged. And in C&I, we're targeting revenue growth in line with GDP, with margins of 8 to 10%. And in N&I, we have a medium-term target to grow revenue to £125 million plus, again with margins of 8 to 10%. Modular Solutions, this consists of our wholly owned subsidiary, Severfield Products and Processing, and also CMF, which is our cold rolled joint venture business, which is based in Wales. Although revenue is down slightly at 10.7 million, for the first time Modular Solutions has reported a profit, reflecting an improved sales mix of higher margin Severstore and Rotoflow products in SPP. The divisional result of 200,000 also includes the share of profit of CMF of 0.1 million, and the lower profitability at CMF reflects some under recovery of overheads as the business ramps up its new and expanded production facility in Wales, which became operational over the last 12 months. Strategic target of Modular Solutions, that is also unchanged, and we have a medium-term target to grow combined CMF and SPP revenues to between 75 million and 100 million at margins of 10% plus, so slightly ahead of our core construction business. In India, JSSL has reported a profit after tax of 1.2 million, of which our share was £600,000. And this reflects revenue of 48 million, which represents a decrease of 30% over the previous period, following a reduction in output to 32,000 tonnes from 44,000 tonnes, reflecting the timing of work in JSSL's order book. And it's worth pointing out that similar to our main group, taking a 6-month snapshot of India doesn't paint the full picture, because with the majority of our contracts lasting between 9 and 12 months, you need really to look at the full 12-month picture to get a fuller understanding of the results. Nonetheless, operating margins have increased to 8.2% compared to 5.5% in the previous period, and that reflects an improved mix of work and strong operational delivery. Finance costs, they were 2.5 million. They're unchanged from the previous period. and reflect a continued high level of borrowing, or higher level of borrowing in the joint venture, which is partly to do with the impact of inflation and working capital, but also higher letter of credit costs, which are linked to higher value steel purchases. Overall, looking forward to the full year, despite the lower activity levels in H1, JSSL's output for 2024 is expected to exceed 100,000 tonnes, including subcontracted work for the second year running, given the volume of the work already secured by the business. And 100,000 tonnes definitely doesn't represent our full aspirations for the business, which Alan will cover on later. Onto the balance sheet, not a huge amount to say here, only that the pension liability has decreased again by around 1.7 million to 11.2 million pounds since the year end, and that mainly reflects another increase in the discount rate and the ongoing deficit contributions of 2.5 million, which were made during the year. The triennial funding valuation is currently in progress, and that has a valuation date of 31st of March 2023, and we expect to finalise that in the new year. And then finally for me, on cash flow, our balance sheet and cash continues, balance sheet and cash position continues to remain healthy. We had another period of strong cash generation, resulting in period end net funds, excluding the IFRS 16 lease liabilities, of 0.4 million. And this includes the acquisition loans that are outstanding of 26 million pounds. The improved cash position reflects an operating cash inflow of 18.2 million and also an inflow from working capital of 15.6 million, which represents an improvement in underlying working capital of around 6 million pounds and new advance payments on a large project of 10 million pounds, which we secured in H1. And that takes total advance payments in the business to 20 million pounds at the end of September. Year-end working capital, excluding these advances, was around 5% of sales, and that's back within our normal range of 4 to 6%, which we also measure excluding the advance payments. These inflows have been offset by the acquisition of Vertman for a net cash consideration of 23 million pounds, and contingent consideration payments of 1.2 million pounds, which relate to the acquisition of Dam Structures in 2021. And as a reminder, the maximum consideration for Dam was 27 million pounds, with 12 million paid up front, 7 million paid up in 2023, and then a further 8 million contingent on certain work winning targets spread over a 4-year period. And the payment you can see in the bridge here of 1.2 million, that represents the second of these annual contingent payments, taking the total contingent consideration paid to date to 2.7 million. In the first half of the year, we also spent money on CapEx of 5.3, again, as we've continued our capital investment programme, and also share purchases of 2.7 million pounds, as we've now stopped issuing shares for our LTIPs and share save schemes and are buying them in the open market instead. We've also invested in corporation tax and interest payments of 4.3, and these just the normal run rate payments for these. Returning to working capital, we expect an outflow of around 20 million pounds in the second half of the year as the customer advances that I just referred to unwind. And given this, we're continuing to guide to an unchanged net debt position of 28 to 30 million pounds by the end of FY24. And I'll now hand back to Alan, who'll take you through the rest of the presentation.
So, moving on to strategy, our strategic priorities are unchanged. They've been pretty consistent for the last few years, and we believe have delivered clear and demonstrable progress for the group, and we believe the same priorities will continue to deliver further progress in the coming years. First and foremost, we're trying to drive growth. We've improved our kind of sectoral position, we've improved our geographic position, most recently with the acquisition of Vertman, and we've got opportunities to pursue organic growth on a wider geographical area. In a nuclear infrastructure business, we've developed framework agreements, which gives us good long-term visibility and pipelines of work. We've got a new and growing modular solutions business, which is showing strong growth potential, as Adam said earlier on, and we continue to have an appetite and the cash flow to support further acquisitions in support of all of that in the coming years. Underpinning all of that is the continued improvement in operational efficiency. It involves an ongoing capital investment programme. It involves relentless improvement in efficiency in our production and design, and most recently the launch of our digitisation project, Project Horizon, which I'll say a bit more about in a second. India, we've referred to already. We've got a joint venture there. It's developing strongly. We've refreshed the strategy there, and we see significant potential for long-term value creation in that business, which we'll expand upon a little bit later. And finally, really an essential part of pretty much any business this day is the ESG position, and we've tried to adopt a leadership position there, which is standing us in good stead commercially and with clients. If we just touch a little bit, the next slide on Project Horizon. This is our kind of long-term plan to sort of digitise really as much of the business as we think can be digitised. We launched it a year ago, and there's a roadmap to that full digitisation of over 100 clearly scoped and defined projects. Of that 100, about 50 are short term. We've completed 11 of these already. There's another 20 in progress, and we hope to have completed most of the first 50 by the end of the next calendar year. A lot of the early stage projects are fairly low-key system upgrades, integrations, better transmission of data, and so on. But there's enough kind of tangible benefits coming out to cover the cost of the full-time team we have there. But that team is now fully populated. We've got about 14 people full-time on the team with a range of different disciplines, and we think we're off to a good start in building good momentum. That will continue over the next few years, and we think as we build more momentum, we'll start to see more net tangible benefits over the next 2 to 3 years. I'll pass over this briefly. It's just some examples of where we're taking leadership positions across the whole spectrum of ESG. I think it is something that's important to us. It's important to our clients, and we're always looking for sort of new ways to add value and maintain that leadership position. So some of you may be more interested than others, and we can take questions on that later, but we just include this to illustrate what we're trying to do. Also, from a strategic standpoint, we see quite a big influence from the whole the transition to the green economy over the coming years. We had this slide during the last presentation, but since then we've added a kind of sixth bubble for energy infrastructure to incorporate some capability we acquired with the Vertman acquisition, which revolves around the modular construction of transformer stations for electricity grids. So there's a lot of work coming at us from this whole green economy transition, and there's another slide later which puts a bit more flesh around some of the opportunities that we're beginning to see there. So moving on from the strategy to have a deeper dive into the UK and Europe, we referred in our press release on Tuesday to some more challenging market conditions, and there's 2 or 3 points to kind of unpack there. Firstly, the distribution market, which has been quite strong for us in the last 3 or 4 years, it is quite weak. We highlighted this back in June. It wasn't clear when it would start to recover, and we're still in a fairly weak position just now. We're starting to see some signs of recovery there, but how quick that will be, it remains to be seen. More broadly, we saw the cancellation of the Sunset Studios contract that Adam referred to back in June, and we're also seeing some delays in some sectors in decision making, which we can generally relate to the kind of the wider economic environment. So we're really just flagging that we're not immune from that. We are seeing some delays in the whole decision-making process, which we weren't necessarily expecting a few months ago. Notwithstanding that, I think inflation is much more manageable now and is reducing, so that's a bonus. Steel supply continues to remain stable, and we were pleased to see the recent announcements from British Steel, who are going to invest in some new electric arc furnaces in the UK. So that will secure the kind of UK's steel supply pipeline for the long-term future in a low carbon way. So we're pleased at that. And looking beyond some of the short-term kind of delays in decision making, we believe we have a really favourable outlook, medium to longer term in many of our market sectors, and we will expand on that as we go along. Many of those relating to the sort of the low carbon economy, as I've already touched on. This puts the order book in context, relatively stable over the last couple of years, and we're beginning to see a bit of growth in the kind of mainland Europe order book, and I expect to see more of that as we build momentum following the acquisition of Wertmann earlier in the year. The next slide really continues to reinforce the breadth and depth of the group's capability, the breadth of the order book that gives us, which reinforces the kind of resilience that we believe we have across the whole economic cycle. If we take a deeper dive into commercial and industrial, the order book makeup just now, and also where we see the pipeline developing in the future, industrial remains the strongest element of it. That includes car battery plants, includes wind turbine monopile plants, and we see that whole sector continuing for the foreseeable future as part of the whole green energy transition. Commercial offices have seen a step up in recent months, as we expected, with a good visibility of that pipeline. If we make one comment, the step up maybe hasn't been quite as great as we thought it would because of some of the delays in decision making, but it's stronger than it was nevertheless, which we're pleased about. Distribution, you can see, is fairly low at the moment at 3%. 2 or 3 years ago, that was as high as 20-25%. So it puts the kind of current weakness in context there. So we look forward to the sort of a return of that market over the next 6-12 months or so. Data centres are picking up a bit. There's still quite a lot of data centres in the pipeline in the UK, Ireland, and continental Europe. Stadia and leisure has dipped in the last 6 months, partly because we've worked towards completion of the new Everton Stadium from our perspective, but also this sector included the Sunset Studios contract, which was cancelled. So that's now at an unusual low, but there's a pretty steady stream of projects in the pipeline there, which we will see that to pick up in due course. Just looking more generally at the European position, we made the Wertmann acquisition, which is described here as VSCH, that's Wertmann Steel Construction Holdings, back in April. The integration of that is going very well. We're well through our kind of 6-month integration plan, and we're now planning to sort of rebrand that business early in the new year with the full support of local management, and we're also going to sort of integrate it more fully with our pre-existing European business to sort of really solidify that kind of European presence and start to sort of look outwards and build in the months and years the months and years ahead. So I think we feel really quite positive about our position there, and I think there will be scope for further acquisitions and European market consolidation in the years ahead. If we move on to nuclear and infrastructure, reasonably stable kind of order book there, as we'd expect, which reflects this general more stable nature of that market sector, less susceptible to cyclical trends. The other point to mention there is that there's a lot of work in nuclear which comes from framework agreements, which we have visibility of, which aren't yet in the order book. So the underlying position is perhaps stronger than the kind of headline order book would suggest here. There's on infrastructure, we're doing a lot of work for HS2 on phase 1. We're well on with some of the bridge programs there. The tenders are beginning to come through for some of the station work, and we're about to start work on the Old Oak Common station, but some of the other stations are still to be tendered, and we're hopeful of getting good positions there. So that'll keep us reasonably busy for the next 2, 3, 4 years, or give us a steady pipeline of work from HS2 for the next 2, 3, 4 years. We've had a question on the impact of the cancellation of the phase 2 from Birmingham to Manchester. Will that impact us? It will have some impact in the longer term, but no real impact in the short term. And by longer term, I'm probably talking 4 or 5 years out. We might lose a kind of £20 million a year of work or so from that, but we believe that there are more than enough opportunities elsewhere, as we'll come on to, which will more than compensate for that. So no real major impact from the cancellation of HS2 phase 2. I think I think in all these areas there's a strong pipeline. Referred to the nuclear framework agreements. We have good visibility 10, 15 years out in many parts of the nuclear business, which is a real confidence booster for the business. It's a solid platform and allows us to see through much of the economic cycle. We've got a slide here which I'll just pause on, which tries to sort of develop the theme of the whole green economy transition, decarbonisation, call it what you want. Now, we call this UK energy infrastructure momentum, but really it applies more widely across Europe and beyond. And on that little graphic are, for us, tangible manifestations of the types of projects which that will mean. And we have either done, are doing, or are tendering for pretty much all of these different types of projects that you can see there, are working on. And we believe there's an enormous wave of that coming down the pipeline over the next 5, 10, 15 years. We could broaden this out further to include battery plants. There's some other aspects of the decarbonisation not here also. We could include our modular business, which is got a growing market for switchgear for offshore wind farms, data centres and such like. But it really sort of captures in a tangible way what we think the whole green economy transition will mean for us as a business, as all this volume of work and investment builds over the next decade for the changes that really has to happen. And I think in terms of the end game, we are fairly neutral on what the kind of end game energy mix ends up being. If it's mostly nuclear, that's fine. If it's mostly renewables with a bit of nuclear backup, that's also fine. But however we get there, there's an enormous amount of investment which will translate into the built environment with a lot of steel components, which we believe we can play a strong part in the years ahead. Just moving on to modular briefly, Adam mentioned it's still relatively small, but quite big ambitions for it. 3 different components: our SEVERStore product range, which is the kind of a steel containerized kind of electrical switchgear, backup power, traditionally used in oil and gas and hard to reach rail sectors, but increasingly used in renewable energy sectors, data centers, and so on. So that market is growing, and we're looking at we're already developing the product range with more developed in the pipeline as well. Supply chain for us is the kind of steel frameworks for modular buildings of all types, commercial and residential, schools, hospitals, and such like. Most modular buildings have some form of steel frame, either hot rolled or cold rolled, which is made from coil. We have all of that capability, and we've got a kind of team focused on developing that and getting good traction in supporting the development of the modular construction market from a supply chain perspective. And then finally, bulk handling solutions is our Rotoflow product. It's a niche product which helps bulk handling systems for paint, water treatment, and so on. Can also be used for food production, and we're broadening out the market access both geographically and sectorally there, because that's a good kind of niche profitable product for us. It's never going to be huge in revenue terms, but it can be a good profit contributor, and we want to develop that in the years ahead. So really quite a kind of an interesting business. And the next slide just really summarises many of the growth opportunities I've been talking about there. So it's small, but I think if we're looking 3, 4, 5 years out, we'll see that become a more substantial part of the overall group, which we're very positive about. Moving on to India, the key thing really here to draw out is the 4th bullet point down. We've always been very positive about the potential for steel construction in India. The whole thesis was that the economy is growing strongly, and that steel has an unusually low market share in construction in India compared with the rest of the world. We're now up at 100,000 tonnes. We're now through COVID. The business is now comparable in size to the UK and Europe, and we spent a lot of time and effort earlier in the year revalidating our strategy and business plan, and that reaffirmed absolutely the potential for the economy and the steel construction market growth over the next few years. And we believe we can grow from 100,000 tonnes up towards 250, 300,000 tonnes over the next 5 or 6 years, hence the need for a second site for expansion. So it's on the growth curve again as it was before COVID, and I think that's going to sort of build momentum in the years ahead and become really quite a substantial part of the business, creating lots of value. The order book in context there shows it stepped up from June. We're now kind of close to kind of record high, and the pipeline is building even more than that. So we'd expect to start to see further and sustained increases in the order book in the years ahead. When we did the revalidation of the business plan, we did quite a lot of detail. You can start with the macro picture of the Indian economy, what rate of growth is forecast there, what construction play in that. But you get to this level of kind of granular data, what will it all mean in terms of these different sectors? Most of these sectors will be familiar from the UK and Europe, but in each one, when you break it down, the opportunities within India are enormous. You could almost build a steel fabrication focusing on one individual sector for the next 5-10 years and do very well. We can do all of these, and our challenge is to make sure that we align our output and our business development focus with the sectors and with clients where they value the skill, the capability, the engineering knowledge and value that we can add there, along with the professional service that we deliver. There'll be a lot of price competition in some sectors. We're not really interested in that. We want to make sure that we select the sectors where our value is most appreciated and supports the long-term profitable growth of our business and generates that value, which we absolutely believe is there to come. So finally, just to sort of a recap of the summary and outlook, we've had another good period of performance, the profits up 17%. Cash generation has been strong, the balance sheet remains strong, and that all gives us confidence to increase the dividend once again. The order books remain strong and stable, reflecting strong inflow, and we believe, looking at the detail, that the quality of order books that we have are high. There's some challenging market conditions, as I said earlier on, but we're navigating through these just now. But it'll be nice when the kind of uncertainty starts to lift, hopefully in the near term. But we're navigating through that well at the moment. India, really very encouraging, very positive, and very exciting for us. And all that means in the near term is that our expectations for the current financial year are unchanged, and that the longer term outlook for the group remains favourable with some excellent growth opportunities, as I hope we have demonstrated. So that brings an end to the formal part of the presentation.
Perfect. Alan, Adam, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received questions throughout today's presentation. In fact, and if I could just ask you to read out the questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
So we have a question from Marcus, which reads, with EU and UK markets difficult, how much of management's focus is on Indian opportunities and what challenges do you see in India? I think I would start with the first part of that question and say that we see some sectors in the UK and a bit in Europe as being difficult and challenging. Other sectors are fine, as we've said. So there's just enough to give us a little bit of concern in some areas, but we're generally reasonably positive about the kind of growth prospects overall across the UK and mainland Europe on the back of the Vertman acquisition. That is all separate from the Indian focus. I think our focus is absolutely on India because of the long-term value there. And I think the biggest challenge will be, as I said, making sure that we align our growing output with those sectors which will deliver the best returns. And I think we'll have a lot of a lot of choice there as the market picks up. Thank you for that question. There's another question from Ben. How are you measuring the impact of Project Horizon on projects completed? Do you see providing a competitive advantage? I think we have very detailed progress measurements in all aspects of Project Horizon. I say some are less tangible than others. A system upgrade is less tangible. Better connecting of data and system communication, less tangible. But as we go through it, there are other more tangible projects like an automated QA record system, which enables us to sort of generate QA records for the nuclear industry in particular, automatically, avoiding the need for significant manual effort, without which we'd have to recruit lots more people. So there's a range of examples there, but every single project has been measured, tracked, clear goals, and we believe that as we build more and more momentum over the next couple of years, we will see more competitive advantage becoming clear, either in terms of the service we're able to offer, in terms of quicker design, more flexible design, more design options, more design efficiency, and also in terms of reducing the cost of project delivery, which will either feed its way into better prices for clients and give us an advantage over higher price competitors, or in terms of bottom line margin support. So I think as Project Horizon evolves and over the next few years, we will see more and more material advantage emerging, which we will be tracking rigorously. And that's all the questions we have at the moment. Happy to take any more if there's any lingering.
Yeah, Alan, Adam, I think that's all the questions, and I think you've actually answered all the questions you can from investors. And of course, the company will review all the questions submitted today, and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Alan, could I just ask you for a few closing comments?
Yes, I think thank you all for listening. It's becoming a more important part of our results roadshow, this forum, and look forward to any feedback, and we hope that's been informative for those of you that haven't seen the message before. So thank you all of you for your time and attention.
Perfect. Alan, Adam, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SEVERFIELD PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.